The Federal Reserve hiked interest rates and crushed your 60-40 portfolio. Bond dealers mark down the price of your treasuries the moment Washington prints more debt. I will teach you to read the yield curve and buy short-term treasury bills to earn more interest than your bank pays on a savings account. You carry a 6.5% interest rate on your home loan today. Traders in a massive financial network dictated that exact number. Your bank and the Federal Reserve watched from the sidelines. Most citizens ignore this $145 trillion trading floor. Market makers determine the cost of your vehicle financing. Corporate executives rely on this network to secure your employment, and fund managers build your nest egg. These same participants wiped out 16% of the conservative assets inside millions of individual retirement accounts during 2022. Everyday bondholders lack a functional grasp of these specific debt instruments. Mastering these mechanics lets you calculate the exact dollar cost of every market fluctuation. A standard bond operates as a direct loan. A local municipality, corporation, or national government skips the bank and asks regular investors for cash. You hand over a specific sum called the principal. The borrower makes two firm commitments to you. They send a set yearly interest payment called the coupon. They return your initial sum on a predetermined deadline called the maturity date. You can reduce the entire document to a simple financial agreement. You give cash today, and they pay annual interest before handing the original amount back later. Millions of investors trading these individual agreements create massive global market influence. Elected officials take out more loans than any other single entity on the planet. Financial analysts tallied the national debt at $39.2 trillion last month. Most ordinary citizens struggle to visualize such a massive financial figure. Politicians spend an estimated $1.05 trillion each year to cover the interest on those loans. Accountants calculate that daily interest bill at $2.88 billion. Lawmakers allocate more cash to debt interest than to the entire military. You fund every cent of that interest through your taxes, and bond traders dictate the rate politicians pay, which happens to be the exact same traders determining your home loan rate. You only need one basic rule to follow this video. Higher rates push down the market value of older debt. Lower rates push those same prices up. You see prices and yields move in opposite directions every time. Picture a specific transaction to see this math. You buy a $1,000 government note yielding 3%. The government pays you $30 annually. Months pass before the Treasury issues fresh notes yielding 5%. Those fresh notes pay buyers $50 annually for the same $1,000 investment. You decide to sell your older note. Buyers refuse to pay $1,000 since they can buy the newer 5% option. You slash your asking price until your $30 payout matches the new 5% yield. You drop your price to roughly $600 to hit that 5% target. The government still owes you those future $30 payouts. The Treasury will still hand you $30 yearly and return your $1,000 at maturity, yet you see a $600 valuation on your statement. Traders multiply this exact pricing mechanism to create the huge losses we discuss later. You can ignore most of the $145 trillion bond market. One specific instrument controls your borrowing costs, the 10-year U.S. Treasury note. This government debt currently pays investors a 4.5% return. Bankers use this exact yield to calculate the interest rate on your home loan. They build the final number from this baseline. A loan officer faces a simple choice. The bank can lock up capital with the federal government for a decade and collect a guaranteed 4.5%. The alternative involves giving you a 30-year mortgage. The institution demands extra compensation to accept your personal financial risks. You might lose your job or miss payments entirely. The lender tacks on roughly 2 percentage points to cover these specific hazards. Adding that 2% risk premium to the baseline 4.5% Treasury yield produces a 6.52% national average for a 30-year fixed mortgage. The calculation follows a strict formula. Brian plans to buy a house today. He needs a standard $400,030 year fixed mortgage to secure the property. At the current 6.52% interest rate, his monthly principal and interest payment totals $2,534. Wall Street traders push the 10-year Treasury yield up by half a percentage point during a single routine trading week. Lenders raise Brian's mortgage rate by a similar margin to 7.02%. He now owes $2,667 each month. Brian pays an extra $133 every single month for the next 360 months. Brian loses $47,898 over the life of the loan due to that tiny half-point shift. Traders push bond yields up by a full percentage point during another routine trading session. Lenders raise Brian's mortgage rate to 7.52%. He pays $2,803 each month, adding $269 to his regular housing costs. Brian pays an extra $96,769 over 3 decades because of that single percentage point shift in a distant financial market. You can measure the raw power of these distant bond traders by running Brian's $400,000 loan through two historical extremes. Lenders offered a historic 2.65% mortgage rate in January 2021. Brian would have paid $1,612 each month under those favorable conditions. Lenders pushed rates to 7.79% by October 2023. The identical $400,000 loan now costs Brian $2,877 every single month. Brian purchases the very same house in the identical neighborhood. Wall Street traders dictate his financial fate through the 10-year Treasury yield. Brian faces a massive $1,265 monthly gap because of that yield swing. Brian pays an extra $455,349 over 30 years because bond traders demanded higher returns. Wall Street traders hand Brian a $500,000 penalty without ever mailing him a physical invoice. Brian's expensive lesson shows a massive shock hitting millions of retirement accounts in 2022. Financial advisors have pushed the same playbook on older investors for decades. These professionals direct clients to sell stocks and buy fixed-income assets as they near retirement. Investors build wealth through equities. They guard that wealth with fixed-income assets. The financial industry built the classic 60-40 portfolio around this logic. Advisors pitch a mix of 60% equities and 40% fixed income as the ultimate conservative choice. Investors use that 40% allocation as a financial seat belt during market turbulence. The Federal Reserve shattered that safety net in 2022. Central bankers hiked interest rates at the fastest pace in 4 decades. They pushed the federal funds rate from near zero up past 4% over a span of 9 months. The central bank crushes the value of older fixed-income assets when it raises rates. Financial professionals use the Bloomberg U.S. Aggregate Bond Index to measure the broad domestic market. The value of the securities within that benchmark dropped 13% in 2022. That drop marked the worst calendar year since the index launched in 1976. The stock prices for companies within the S&P 500 fell 18.1% over the same 12 months. Investors holding a standard 60-40 mix of domestic equities and fixed-income securities lost an estimated 16% that year. The protective securities crashed alongside the riskier assets. Fund managers place intermediate-term treasuries in most target-date retirement funds. The value of those specific assets dropped 10.6%. That number marks their worst performance since at least 1926. Investors find zero-coupon treasuries at the far end of the maturity curve. The market pushed these long-duration government securities down 39.2%. Researchers at Santa Clara University analyzed historical asset returns to provide context for those massive losses. They discovered that owners of long-duration domestic fixed income suffered their worst performance since 1754. The United States did not exist back then. The country consisted of 13 colonies. Retirees holding modern portfolios experienced their most painful 12 months in 268 years. Financial professionals use a single metric to calculate the severity of those losses. They call this number duration. Fund managers print it on the official fact sheet, yet everyday buyers skip that page. You use this figure to predict the exact dollar amount a portfolio sheds whenever borrowing costs rise by 1 percentage point. A retiree managing a $500,000 nest egg trusts a secure fixed-income vehicle. A standard broad index fund features a duration rating of 6. She loses $30,000 of her wealth when rates rise by 1 percentage point. Swapping that index for a long-term Treasury fund pushes the rating to 17. She watches $85,000 vaporize from that identical rate hike. The same investor suffers a $55,000 discrepancy. Most retail investors ignore these ratings. Brokers sold them on fixed-income safety, so they stopped reading the fine print. Advisors use this specific metric to separate a minor portfolio scratch from a broken leg. Ignoring this calculation inflicted massive financial damage on millions of older Americans during 2022. Purchasing an individual government note alters the underlying math. The market value shifts downward while you hold the asset. Those paper losses carry zero weight for the buyer. The issuer pays every scheduled coupon and returns the original principal upon maturity. You bypass the daily repricing penalty. Mutual funds operate under distinct rules. These pooled vehicles never reach a maturity date. Managers reprice the underlying basket of debt every single day. Rising interest rates push those paper losses directly onto your monthly statement. The red ink stays locked inside your account. Investors watch those devastating 2022 drawdowns permanently shrink balances instead of vanishing on December 31st. Investors flock to the United States Treasury. Washington remains the world's safest borrower. Uncle Sam prints money to cover dollar-denominated bills. Corporations lack this option. Businesses face bankruptcy when cash runs out. Lenders demand extra compensation for this risk. Issuers offer a juicier return on corporate bonds than on Treasury notes. Traders call this gap the high-yield spread. Investors view a tight gap as tranquility. Participants spot danger in a widening gap. Buyers anticipate defaults, layoffs, and skipped interest checks. The public gets a clear view of corporate health here. Traders track the spread ahead of official economic reports. Traders rewrite the market playbook during moments of panic. You watch money managers dump corporate debt and equities the moment they spot a recession or a shock like a war, a bank collapse, or a credit rating cut. These professionals park their cash in United States government debt. Market veterans call this panic buying a flight to quality. Buyers pile into these safe assets. These buyers drive up Treasury prices and force down yields, completing the shift in an afternoon. Investors rely on the traditional dance between equities and fixed income. Frightened stock sellers push their capital into the bond market. Bond buyers inflate fixed income prices and cushion your total account value. Advisors protected everyday investors for 50 years using this exact seesaw effect. Market participants watched central bankers shatter those historical rules during 2022. Investors watch central banks crush the safe portion of their portfolios and trigger the panic by raising borrowing costs. Central bankers inject poison into company shares and government debt every time they raise rates. You lost your safety net. You watch bankers inflict the exact same financial damage on your protective asset and your risky bets. Portfolio managers apply this exact pricing math to stock markets each trading day. The United States government hands bond buyers a guaranteed yield. Buyers price stocks to offer a higher expected return without providing a safety net. Analysts calculate the equity risk premium by subtracting the 10-year Treasury yield from expected stock returns. The Treasury Department pays 4.5% on the 10-year note. Assume an investor anticipates a 7% annual return from equities long-term. That investor keeps a 2.5 percentage point equity risk premium. Buyers demand this spread to compensate for choosing volatile stocks over secure government debt. Investors see this compensation shrink when bond yields rise. Institutional traders dump shares and pile into fixed income once that spread disappears. Investors chased the 2009 through 2021 stock bull run because rock-bottom interest rates made equities look appealing. Sellers flipped that dynamic during the brutal 2022 market crash. Sellers squeezed the equity risk premium out of existence for many buyers as the Treasury Department pushed yields higher. You can forecast economic futures with more accuracy than any living economist by studying the yield curve. This graph maps United States Treasury bond yields for every maturity between 3 months and 30 years. Current yields register at 3.71% for 3 months, 4.09% for 2 years, 4.5% for 10 years, and near 5% for 3 decades. Connecting these points creates an ascending slope. Short maturities anchor the left side while long maturities anchor the right side. Investors see yields climb as they scan from left to right. Economists label this standard arrangement a normal yield curve. Financial markets display this standard arrangement during most historical periods. You demand increased compensation when you lock your cash into a bond for an extended period. A 30-year loan carries increased risk against a 3-month loan because countless unpredictable problems can disrupt a 3-decade timeframe versus a brief 90-day window. Economists label this extra compensation the term premium. Investors demand this term premium, forcing the graph to tilt upward. Bond sellers invert the yield curve during specific periods. Short-term bonds offer increased payouts against long-term bonds. A 2-year Treasury note pays a larger amount than a 10-year note. Bond traders make a specific prediction during these inversions. They expect the Federal Reserve to lower interest rates within the next 2 years. Traders anticipate economic growth stalling, leaving the Federal Reserve with no choice but to intervene. Researchers at the Federal Reserve Bank of San Francisco tracked the last 10 United States recessions back to 1955. An inverted yield curve preceded all 10 economic downturns. Analysts recorded a perfect 10 for 10 success rate across 7 decades. Other economic indicators fail to match this accuracy. Wall Street professionals trust this specific metric above all other warning signs. Market veterans keep their forecasts quiet during normal conditions. Traders issue the maximum possible warning across the entire financial sector when the yield line inverts, giving investors absolute clarity about future economic contractions. You shield your emergency cash from economic contractions and capture higher returns by picking the right institution. The FDIC tracks average savings accounts at 0.38%. Major American banks pay this exact rate. 3-month Treasury bills pay investors 3.71%. Top high-yield savings accounts push returns to 4.20%. The government backs Treasury bills. The FDIC insures high-yield savings accounts up to $250,000 per institution. You enjoy identical security across all three choices. The institution holding your deposits dictates your profit. Brian keeps $50,000 in a standard savings account at his local branch. His neighborhood bank applies the 0.38% rate to his balance. The bank pays him $190 in annual interest. Brian moves that identical $50,000 into 3-month Treasury bills. The government pays him $1,855 that year. The Treasury option generates 9.8 times more profit from the same principal. Brian leaves his cash at the local branch for 5 years. That choice costs him $8,325 in uncollected interest. He sacrifices this money without accepting extra financial risk. The government exempts Treasury bill interest from state income taxes. Residents in high-tax states widen this profit gap. Check your retirement accounts for bond fund holdings and find the duration on each fact sheet. Duration exceeding 7 means your fund swings hard when interest rates shift. Long-dated bond funds with duration above 15 mimic volatile equities and ditch the safety your broker pitched. You need this number if you hold the fund. The U.S. Treasury sells Series I savings bonds to address inflation worries. These pay a composite rate moving with inflation at 4.26% through October 2026. Treasury Direct restricts purchases to $10,000 per person annually. I-bonds give regular savers the most direct method to shield cash from rising living expenses. Checking the current 10-year Treasury yield takes 5 seconds of effort. Banks raise the costs for mortgages, auto loans, and corporate debt following a benchmark increase. Bond traders interpret a sharp drop as a sign of an economic slump. Economists view this specific benchmark as the primary warning system for the broader economy. You gain a new personal finance perspective by grasping these mechanics. You participate in a system extending beyond wealthy investors managing portfolios. Bankers in this hidden network dictate the cost of your home loan, the growth of your savings account, the security of your retirement fund, and the hiring budget at your workplace. Financial institutions influence each dollar you earn and spend. Market experts share the exact same raw intelligence as regular people. Those experts invested time in studying the mechanics and rejected the idea that finance is dull. You gain a clear advantage by checking the 10-year benchmark on any major financial news website. Lenders add hundreds of dollars to the monthly payment on a standard 30-year home loan following a 1% increase in that specific yield. Corporations face higher borrowing costs, prompting executives to cancel stock buybacks and reduce hiring, impacting your career prospects. You can use this knowledge to adjust your personal strategy before the broader public reacts. You protect your principal and earn competitive interest during rate hikes by moving cash into short-term Treasury bills. Investors lock in higher payouts for the next decade by extending the duration of their bond portfolios once the central bank begins cutting rates. You transform abstract economic news into concrete financial actions by studying these specific numbers.